So why did Joe first ask me to come and speak at these conferences, and then his son Jay to participate? Well, it's because of two things. One, my macro views from global tacit knowledge, I believe, and B, because still to this day, we have the most number of names invested in junior mining in the US. If you take a look at our funds, even though all gold funds have shrunk, our resources and gold stocks are still invested in new explorers. I'm sorry for those who are going to have the opportunity to meet Ralph. He's been quite ill, so he's unable to make this trip. But I will try to go around and visit a lot of the junior mining companies that we have investments in. We have over 30 investments in this incredible menu of stocks to look at. So in life, this to me is one of the most important visuals. It's truth from three different perspectives. So it's so important to have not just one view, but a multiple of views, so you can intellectually arbitrage to discover. They call it in stock picking, price discovery, to try to find out the real depth of a market or the stocks that are there or fundamental analysis perspectives. And I'm a big believer that no one has a monopoly on perspectives and no one has a monopoly on good ideas. So it was 7 years ago, I was set up to have this debate. And they had a ringer that was brought in, Gordon Chang. And I realized that this is a very smart guy, went to Yale, was a lawyer. And my research showed that this was an individual that was paid by unions with his sort of anti-China thesis. So I went back and you can see on the videos this debate we had 7 years ago. And had you listened to him, you would not have invested in China. And this is an ETF to show you that China far outperformed the Canadian market, the big cap stocks with the banks, and definitely devastated all the junior explorers during that bear cycle. So I think it's important to have good discoveries and perspectives, but here's where you put your money. You put your money where there's a real thesis and there's not a political agenda. So the other one that I've had to defend myself on this podium by newsletter writers and it happened several years ago, the anti-royalty companies. And I was always amazed because I was so blessed to be able to know Seymour Schulich and Franco-Nevada. It was the first financing IPO I ever did in 1983, was taking Franco-Nevada public, and understood the royalty model. And when they first took it public, they didn't really have their arms around the royalty model, but it was Seymour who pushed Pierre to create a royalty company because he was a big buyer of oil royalties. And he wanted to be able to apply it with first mover advantage to the gold industry and why it was so important. So we had Rob McEwen up, and he's anti the royalty companies. And what I find is interesting is how has Franco-Nevada done since that debate and that discussion? It's far outperformed the GDXJ, the Vancouver Junior Mining Basic Index, and it's outperformed pretty well everything else. In fact, it's also far outperformed Warren Buffett's Berkshire Hathaway. And that's because it has a superior business model, and the revenue per employee on a Franco-Nevada is like $21 million per person. Goldman Sachs is $1 million. They have royalties on Barrick and Newmont's assets, which are $500,000 of revenue per employee. It's just a superior business model. And what we've seen now, these newsletter writers that were so anti this royalty business, now they're getting behind many junior royalty companies. New companies have come out in the past couple of years, and they've also been spectacular winners when they can get good royalties. So just realize that you can't build a mutual fund portfolio unless you have 21 names. That's the law, minimum 21 names. So there's not really 21 great royalty companies to go out and buy, but in the ETF I launched a couple years ago, 30% were royalty companies. So our portfolio manager, Top Gun, Ralph Wallace, as I mentioned earlier, won't be here, but this is a classic where he was very early in picking West Dome, and it's been a huge win. And I also gave a speech which seemed to, I was surprised by it, but how it sort of captured the imagination of the Denver Gold Show, the LBMA, and it was the idea of trying to educate you. That's my job, I think, when I come up here, is to educate you that something big is happening. And I gave you that great video of the Trump pump and dump bot. that basically explain how quants use bots that basically analyze press releases and quickly within a second go short or long a stock, a currency, etc. And that has not gone away. And that particular presentation was first given here before I gave it to the LBMA and the Denver Gold Show, is trying to inform you that there are other factors to consider, another perspective that's driving markets. So what are the 5 major forces that people should look at when you're looking top down? You have to look at government policies as a precursor to change, populations, urbanization, and just basic cycles and the significance of technology. Government policies are a precursor to change, and it's so important to recognize that America, which is about 30% of the global GDP, as you can see, you can take complexity and simplify it. That's a binary model. Government policies are either monetary or fiscal, and monetary are negative real interest rates and money supply, and fiscal is basically tax and regulation and government spending. Where is it going? Why is it going? Why is it significant to you as an investor? So we have this government debate. We have this big precursor of Trump versus China. It's really simple. America wanted a level playing field because they have a $13 trillion economy that China wants to sell into, and there's very expensive tariffs for American companies to sell into China, which has a much smaller overall economy to sell into because they predominantly develop and sell finished products like airlines and medical technology, etc. And that was a debate, but it was important. It was important because China and America are 40% of all global trade. And then the other macro force we'll have to be worried about is population and consumption. When you look at affectionately known China and India, is Chindia. And Chindia is 40% of the world's population. And you can take a look there in the bull market of last year, still the Chindia ETF, it's also done almost as well as the S&P 500, and it outperformed Canada's big cap stocks. So when I look at the world, I look at 40% of the people, almost 3 billion people eating every day, wearing clothes, running shoes, and now with technology, they all want the North American dream. Another talk I gave in a presentation here in 2015 was the great tectonic shift of physical gold, leaving the West, going to the East. And where it leaves America, it goes to Switzerland, it goes to refineries and is showing up. And all of a sudden, China became, from being a price taker, China became a price maker. And they got control of the bidding of basically the quote market for the price of gold. And what did that mean to gold investors? And you just heard an incredible presentation. I'm so honored to be coming after Ross Beatty on his thesis of gold and why it's very, very important, how he shifts this cycle that he's looked at gold. Previous was copper. He's done these different asset classes, and he's brilliant of catching a big trend. And this is a secular movement. It's to recognize this, and I've been writing about it since 2015, and there's the evidence of the continuous buying. So macro forces, trade wars, why did it truly hurt the global economy? In particular, Germany is still trying to get off the canvas from that punch out. And now we're going to talk about people. So consumption is based on one measure. China's economy is the biggest in the world when you look at GDP per capita. And what's important here is, and go back in history, in 1840, China and India were 40% of the global economy. And they fell to basically less than 5%, and now they're growing again. They're 40% of the world's population, and when you look at GDP per growth, you can see the importance of having China and the US and India. And it's highly correlated to gold demand, the love trade, the great, great love trade. Is so important to look at GDP per capita. And then I've talked about other talks, the One Belt, One Road opens up unprecedented opportunities, how China is trying to become the America of reaching out to the world. But they know their currency has to be backed by gold. That's why they continuously buy gold. Down the road, we're going to see the renminbi to be competitive to the euro, to the Japanese yen, to the US dollar. That's the focus, but now they have to build the relationships right across Asia throughout Africa. And China's doing something else that's really significant, is creating smart cities, where you have cameras on every lamppost and AI to be able to see who's a bad individual. People have not paid their parking tickets, etc. They can quickly nab them in the streets. Women feel much safer in these areas. This has been explored, it's been developed in cities throughout the world, and it's coming here. this idea. And what I found interesting is that they're going to need GPU chips. You're going to need data mining, and you're going to need GPU chips because they all use AI. And then the new era of China's internationalization, it's not stopping. And it's going to continue. Gordon Chang, it's much bigger than your comments. Now, let me tell you about Trump. What I learned about President Trump. Why did he focus on manufacturing? It's interesting economics. Most people said, oh, because he's going to get uneducated blue-collar voters. Not really. He's a Wharton grad. And what I discovered, this is actually at a conference that was held in San Francisco, was that if you move 1% of manufacturing, you improve it from 9% to 10%, you create service jobs of 6 to 9%. So by taking the 9% of America, 9% of his economy was manufacturing, if President Trump could take it to 11%, then he was going to improve employment between 12 and 18%, and basically that's what's been taking place. So there's much more leverage in the service industry than there is just focusing on manufacturing. And what's important when you focus on manufacturing is that China is still the big gorilla when it comes to commodity demand. And we're also seeing that China's tourism spent $130 billion in 2018. And the other part is why I created and launched JETS ETF a couple years back was the total outbound Chinese passengers in millions of people and last year they spent more money than Americans did traveling abroad. I was in Salzburg and 50% of the tourists were Chinese. Recently when I was in the New York Stock Exchange, 50% of the tourists in front of the New York Stock Exchange are Chinese. And so they're jamming up the hotels. Hotels are more expensive. They're not kept up. And there's a real tipping point that when you have 130 million people that are making 80 grand a year minimum as a sort of a minimum average at that level, all of a sudden tourism takes off. Now, what's really impacting gold outside of the short-term speculation we see in the futures market has been this global debt surge to $250 trillion in the first half of 2019. But for you as investors, it's so important that you look at global PMI, Purchasing Manufacturers Index. When you look at GDP, you're staring out the rearview mirror. When you look at PMI, you are looking 6 months out. And we've done detailed analysis. I write about it every month and the data points come out. So a lot of people want to see this man get derailed. And so what could do it? It could be PMIs. Because if PMIs don't turn after the trade war settlement quickly, because it's a 6-month precursor, that you could have, not until this time next year, that the manufacturer starts to turn in America because Germany is still in a bear market. But as you can see here, the US manufacturing sector started to contract at its fastest pace in 10 years. Now looking at global PMI, it's a different story because Europe in particular and Japan turned around and started going back to quantitative easing with zero negative real interest rates. In fact, Denmark was paying you to take out a mortgage. And you have to pay a lot of money to actually have a bank account and they don't give you any interest. The fact that you can just store your money there is a cost. So what they started printing this money, and you can see there's a turn in global GDP, in global PMI, which is positive, and why emerging markets last year did exceptionally well. Another macro force are regulations, and they're growing dramatically. And as you can see in this visual, they're just went out of control in the US. And under President Obama, you had FATCA, and prior to that, you had Sarbanes, the AML and KYC, which are continuing to grow. And you can see what President Trump did when he came into power. He basically said, you have to cancel a new reg. You have to cancel an old reg to bring out a new one. And you have to cancel 2 for certain industries to open a new regulation, and you've seen regulations fall. Well, that's like a tax break. Rising regulations is a tax cost. Falling regulations is a tax break. And one of the big factors of President Clinton when he came into power, and it doesn't matter Democrats or Republicans, is he deregulated. He streamlined regulations and he deregulated. And that was a big part of the internet boom that took place. So this PMI, coming back to that story and why it's important, what we've noticed is that when 1 month is above 3 months, then you can expect the commodities to be rising over the next 6 months. And each month, if the last month is above the 3 months, that momentum takes place, there's a higher and higher probability of very strong commodity demand. Vice versa, if 1 month goes below 3 months for global PMI, it has a bigger impact. China's PMI numbers are more correlated to the price of oil because they're the biggest importers of oil in the world. And when you look at the Canadian dollar, it doesn't matter who's in charge, really it's about oil. But government policies that can stop exporting of oil can have a greater detriment impact on the Canadian dollar. So the Canadian dollar is most impacted by what it exports the most. What does it export the most? Commodities. What commodity in dollar terms does it export the most? Oil. So the correlation with oil is very high. When you go to Peru, it's copper. And when you go to Colombia, it's also oil. So over the past 20 years, it's important to recognize that 80% of gold has been up, 20% has been down, and the largest hedge fund in the world, Ray Dalio's Bridgewater, is always 6 to 15% long in gold and rebalancing on a quarterly or annual basis. And still Wall Street has usually negative statements to say about gold. And gold still ended up in 2019 at an up year. And recently gold has had a huge surge. And what's important to recognize this recent surge has been the futures market, and that is a risk. Pierre Lassonde did a webcast. You can go to our website. You can visit it. He made a forecast of why gold can be $25,000 in the next 30 years. And what's important here is in 1989, India was 10% of all gold demand, rising GDP per capita, driving the love trade. You see they're now 53% of all gold demand. So money flows into exploration and the speculation have been hurt by first crypto, cannabis stocks, and also now the GDXJ, triple bull and triple bear. There's actually very little hard money going into the cash trade of gold or even stocks. There's just so much dominated by futures or leverage ETFs. This creates more volatility. The royalty companies, if we continue this to show you if they've outperformed the GDXJ, and I'll be speaking on a workshop later today. I highly recommend how Quant World is impacting and how GoldSpot is applying and helping gold mining companies from Yamana to find discoveries to Gran Colombia. I'm going to give a case study later today. So these macro forces that I believe, ESG, and it's becoming so significant, and my experience now in several of these junior mining companies, et cetera, as an officer, I find it interesting that governance is a big issue. Respect, especially millennials, to respect corporate governance is such an educational process. But what's important for you to realize is that more and more money has to go to welfare programs, and a lot of this is being pushed out of the EU. There's sort of a socialist policy, and now they're dictating for government pension funds, et cetera, that you have to be ESG compliant, and ESG for goldfields costs $40 million a year. So what will this do to mining in my theory is that commodity prices can surge greatly, but a lot of junior mining companies will not be able to participate. They will not be able to participate in this next cycle in the gold space because of all the regulations and the difficulty. There's 3,000 hedge funds that shut down the past couple of years. And out of that, 1,000 used to buy junior mining. We're seeing less money and contraction going into the space. So it's going to be very selective. In the process of only quality management and quality companies are really going to be able to participate. So I believe we get a huge run up in commodities, and only a handful of the names are really going to be able to get the money, and those that have a quant approach will probably have a better narrative, and they de-risk. The quant approach to picking stocks works. That's why I know I launched GoAU. It outperforms the GDXJ. It's done exactly what the model said it would do. And when it comes to exploration, it de-risks spending. So if a company has a budget for $10 million, they can stop wasting $8 million. Basically, that's what quant approach does with AI and machine learning. And it's going to become very, very important. And I also want to share with you is that gold mining does use very little, its footprint is negative for carbon is very little. So this appetite for ESG investing will continue. Junior mining companies are going to have a bigger cost. This is another form of regulation, so less money is going to go into exploration, and so they have to rethink their whole thesis of what they do in their communities, et cetera. This has got big momentum, and it's important for you as investors to understand it. So there's another visual. My time is up. I hope that if you subscribe to Investor Alert, but most important to remember that we've all got to have gratitude. Because research has shown that you cannot capture opportunity if you're a perpetual bear. If you're a preacher of gloom and doom, you will miss the next industry, the next cycle. You will miss opportunities. and you won't live to be 100 years old. As in all the studies done, and many people that live to be 100 years old, they have a positive attitude, a positive, realistic perspective. And guess what? We all woke up today, and many didn't. We're all blessed to be here and to have a community of active speculators and investors in this space, and to be able to listen to a world-class, very humble man, Ross Beatty. And it's so important when you get the opportunity to hear how he thinks. It's your blessing. Thank you very much, ladies and gentlemen, and happy investing.